Good morning, everyone. Today, we are going to discuss another new topic, which is about financial reporting and analysis. The last two classes, we have discussed about compliance functions, and then we have discussed as a part of the compliance function, we have discussed about the anti-money laundering and terrorism financing, as well as some component of FIU functions and related legal activity, the legal provisions. So if you all have any questions regarding that, you all can send the your question through the inbox or chat box, or if you all have any comments, even you all can send those comments through the chat box. That is the arrangement we are having in the class. So today we are going to discuss about the financial reporting and analysis, which is a new topic, and there's a 20 marks questions in the exam papers. It's generally about this financial reporting and analysis as well as audit. So generally, if you see the past paper questions, you can see a separate structural questions with related to the financial reporting and analysis as well as audit. Audit, of course, we will cover the next class. Today, I'm planning to finish the financial reporting and analysis today's class. Then we can follow the audit part the next class. So with these two classes, you can able to answer the questions regarding the questions related to the financial reporting as well as audit. And so far, we have completed nearly 5 topics. First, I have started with the incorporations, where we have discussed about some legal, the Company Act provisions. Then we have seen something about the licensing of financial institutions and shareholders' rights. In the licensing of financial institutions, we have seen about the licensing procedure of the banks, finance companies, leasing companies, and insurance companies, stockbrokers, etc. Then we moved to the risk management. There also I told you already there are 20 marks questions with related to risk management. So we have discussed about it. Then we move to the compliance function. So as I already mentioned, the last 2 class we have studied about the compliance function as well as FIU and KYC policy, anti-money laundering and countering financing of terrorism, etc., etc. So having that knowledge, now I am going to move into the financial reporting and analysis. So this is the order I have. This is the order I'm going to cover. So today we are going to see about the financial reporting. Before starting any topic, it is our usual practice that how to or what is that. So as usual, we are going to see what is the financial reporting. The financial reporting is the process of producing statements that disclose an organization's financial status to the relevant stakeholders or users. It involves the disclosure of financial information to the internal and external stakeholder of the current entity. So here in this definition, we can see some important words. First one is the process of producing statements. So what are those statements? So the financial reporting is producing some statement which may be P&L or income statement, which may be the balance sheet, which may be cash flow statements. So there are 3 types of main statements are available in the financial reporting: the income statement, balance sheet, and cash flow statement. So those 3 statements, the producing it is a financial reporting is a process of producing statement. Means these three statements: income statement, balance sheet, as well as cash flow statement. And then actually there are some notes to the accounts, and there are other things also, but these three are the main three reporting statement, financial statements. So producing statement that disclose the organization's financial status. It should give the financial status of the entity. That is, again, we have to see, because okay, we can produce some statement, so that statement should give the financial status of the entity to the relevant stakeholders or users. Here there are, in the financial statement, the different stakeholders are using the financial statement. So who are the stakeholders of an entity, especially in terms of the financial institution, bank and finance companies and other financial institutions? The stakeholders may be the management. We can say the management is one of the stakeholders. And shareholders or prospective investors. If you are a stock market investor, you may be interested on the financial institutions balance, the financial statements. So prospective investors and shareholders. So shareholders mean existing investors, and depositors, and regulators, government authorities. Likewise, there are different stakeholders. So the financial reporting is producing the process of producing the statements that disclose the organization's financial status to the relevant stakeholders. Stakeholders, who are the stakeholders? As I mentioned, there are different stakeholders in an entity, and even the depositors and creditors. Creditors may be one of the stakeholders. So used by the relevant stakeholder. It involves, then again they are saying that it involves the disclosure of the financial information to both internal and external stakeholders. So the stakeholders can be divided into two components or two parts. The first one is internal stakeholders. The second one is external stakeholders. Who are the internal stakeholders of an entity or financial statement? It may be management. It may be employers. It may be shareholders. Employees and shareholders, those type of people can be called as internal stakeholders. Similarly, there are external stakeholders. The external stakeholders may be regulators. It's an external stakeholder. The government authorities may be an external stakeholder. Even depositors is an external stakeholder. Even though the creditors is an external stakeholder, or supplier is an external stakeholder. So these stakeholders can be divided into two parts. The first one is internal stakeholders. Second one is external stakeholders. So in the clear definition, you can see that the financial reporting is a process of producing statement that disclose an organization financial status to the relevant stakeholders, and it involves the disclosure of financial information to both the internal and external stakeholders of the entity. That is the important thing. Understand? Anything you all wanted to ask from me? Okay. Then we have seen in the definition that the stakeholders, it is the financial statement to relevant stakeholders or users. Okay. For these stakeholders, I have said that the stakeholders mean the management, shareholders or prospective investors, depositors, creditors, government authorities, regulators. There are several stakeholders are there. Okay, understand? Then there may be a question, okay, for what purpose this information or financial statement is need to the stakeholders? Okay, you all are saying that we are producing the statement, some statement, and that statements are used by the stakeholders. Okay, why those statements are information, financial information is needed for stakeholders. The first, if you see the management as one of the stakeholder, the first thing is to plan and manage the business and to take important business decision. They need a financial statement. For example, if a finance company, their management is expected to expand the company or expand the business of the company and open several branches, new branches in some area and all. So the management first, when a management will decide, okay, is it profitable, or whether the current financial status of the finance company is adequate enough to bear some additional cost. Because when a company wanted to open a branch, the new branch, definitely at the initial point, there may be losses. The losses may incur at the initial point. So the company has to bear some losses at the initial point. Then only actually after 1 or 2, 3 years only, it will start to gain that branch. In any branch, any business, any type of business, when they put up the new branches or anything, not everybody, not always, but the most of the cases, it won't yield the profit the first day itself or first month itself. It may create some losses through maybe through establishment cost or through operational cost, or because it's very difficult to find new customers at the competitive financial world. So if they open a new branch, other than if that branch is, rather than there is no branch in that area, of course the people may come to that branch. But if there are competitive banks also, bank branches also in that same area, so it will take some time to establish that branch. So definitely it may take some time to earn the profit from that branch. So this branch, when a management decided to expand the finance company's business and establish some more few branches in different area, the management has to see whether the current financial statements are strength enough to meet that additional expenses. So, and whether these profits are adequate enough to bear the additional cost incurred through the establishment of new branches. So, for these type of purpose, the management of the company or financial institution may interested to the financial statement of the company or the entity. That is the first thing. The second one is shareholders or prospective investors. Why they wanted to invest on the financial statement? Definitely, they will have more interested than anybody in the financial statement. As I already mentioned to you all, in the financial, in the company, or especially in the financial institution, bank and finance companies, owners are not run the company. The shareholders, the owners, it means the shareholders are the large number of people. But the few directors, sometimes the directors may not be the shareholders, but they are the people going to run the bank or finance companies or any other financial institution. In this scenario, the shareholders are interested to see the financial statement to check or to ensure whether they have adequate, there's an adequate profit for their investment, and there is a value, adequate value to cover their investments. So existing shareholders will check two things. First, okay, there's a real value in that institution to safeguard their invested amount, the shareholding value, status capital. And then second, they will check whether the company have generate adequate profit for their capital. For those two purposes, the shareholders may have the interest on the, or will have the interest on the financial statements. And the prospective investors, of course, to assess the return on their existing investment or viability of investment in the future business, or that they will just about the viability of the investment, they will see about the they may have the interest on finance statement. And the depositors, of course, in Sri Lanka, most of the depositors are not check the strong financial statement of the banks and finance companies, because as per the central bank requirement, the banks and finance companies has to publish their accounts on quarterly basis to the in the papers. If you see that 2 months or 3 months after the every quarter, 1 month after the quarter or something, there may be a big advertisement in the papers. It should be in Tamil and English as well as singular papers. So the depositor, what the purpose of publishing that accounts is, the depositors has to make sure their safeness of their deposits. So even before deposit, they have to check whether they are investing, they are depositing with the safe institutions. But of course, in Sri Lanka, what the depositors are thinking is, okay, central bank is regulating, so we can just deposit. Those who are giving the high risk, high interest rate, I can put the money into with them because there's a regulator. That of course, that's a good, but they also have the obligation. They have to make sure they are depositing with the financially sound institutions, even though regulators look into that. So to make sure the safeness of their deposits, the depositors may have interest on these financial statements. And the regulators, of course, the regulators will have the thorough knowledge on these financial statements of the financial institution, because they will check each and everything in the financial statements. Because they are the people, they have the mandatory obligation to check whether these financial institutions are safe and soundness. Why I am saying so? Because the banks and finance companies and leasing companies, of course, the regulators as a central bank, as a regulator, they have to make sure the safe and soundness of these financial institutions. But system as a whole, that's the other point. But to maintain the system as a whole, they have to monitor each and every financial institutions. So for that purpose, they will assess the level of risk, availability of the resources to mitigate the risk. I have already teach you all this. So what is the resources to mitigate the risk? Generally, it is capital. Generally, to mitigate the risk, the financial institution should have adequate resources. Adequate resources mean adequate capital to mitigate the risk. And to check the compliance checking also, one of the most important thing the regulators will check. And to make the policy decision and to evaluate the transparency of the financial information, they may interested on financial statement of the or financial reporting process of the financial institutions. Understand? Then again, the employees. Why the employees? To making a bargaining agreement in the discussing compensation of promotions and ranking, because anyhow the employees, if the particular entity is viable and they are making a profit in a good manner in a long term, then only they can make or they can continue their employment. So for that purpose, and if the company making a more profit, a financial institution making more profit, then they can bargain their promotion, their compensation, their salaries and everything, even their bonuses. For that purpose, they may have the interest on the finance statements. Again, rating agencies. Rating agencies, of course, why? Because they are the people going to give rating to the finance institution. If you see that the banks and finance companies, getting the rating is mandatory. There may be different rating agencies. In Sri Lanka, there are two main rating agencies here. One is, what are those rating agencies? The one rating agency is Fitch Rating Lanka. The second one is IGRA. So those type of rating agencies, even in the international level, if you see that Moody's, S&P, Standard and Poor's, and Fitch Rating, those three rating agencies are sort of very popular rating agencies. So those type of rating agencies in the local level, these Fitch Rating Lanka and IGRA ratings, they may have interest on the finance statement, the rating agencies, to check whether they are to assess the credit worthiness of the finance institutions or instrument. Why I'm saying the finance instruments here? Why I'm saying that to rate credit worthiness of the institutions and instruments or instruments. Because generally we may heard about the rating of the credit rating of an institution. If you see the banker's loan, or if you see NSPO, commercial or HNB, there are ratings. The AA, A plus, and the AAA. Likewise, there are ratings. That is okay, institution. What is the instrument? Why it has been mentioned as an instrument? Because when they issue, for example, when they issue the debentures, it is a mandatory. They have to get. It's one of the regulatory requirement. Maybe the SEC, Securities and Exchange Commission requirement. That particular, if they wanted to list those debentures in the Colombo Stock Exchange, they have to fulfill some requirement. So one of the requirement, they have to get the rating for that particular instrument. So when they are issuing the debentures will be rated. That's what they say, that the instrument rating. So the financial institutions also having the ratings, the creditworthiness rating, and financial instruments. When they issue the particular instrument, there are the creditworthiness rating also. For this purpose, assign the rating to the institution. Are they just assigning the rating? No, they will assign based on their analysis of the financial statement. So for that purpose, these rating agencies may have interested on this financial reporting or financial statement of the institution or entities. And the competitive financial decision of financial institutions, or maybe those who are the borrower, the lenders to that financial institution or any entities, they may to make the lending decision and to assess the repayment capacity of the borrowers, they may have the interest on the financial statement. Again, the government agencies, I have already explained to you all that to make an important policy decision and to facilitate collective revenues. If it is a tax department, inland revenue department, they may interested. They have a full interest on the financial statement because they have to get the tax. They have to collect the tax. So for that purpose, they may have the interest on the entities' financial statements. So now we will have sort of a very detailed starting or the introduction, where we have seen what is financial reporting, the definition, and the stakeholders, who are the stakeholders, and the internal stakeholders, external stakeholders. Then we have seen, okay, for these stakeholders, for what purpose they need this reporting. So management and regulators, employees, shareholders, depositors, rating agencies, and financial institutions and government agencies, why they need the financial information. So this is the sort of introduction. So now we are, if you will have any questions in this regard? You will have any questions? If you don't have any questions, I can just move to the other section. Okay, this is regarding the financial reporting process, because if there is any, because it's a reporting, there's a process. When they are publishing the financial statement, or when they are reporting the financial reporting, it has certain process. They are not publishing or reporting the financial statement at overnight. There are some procedures which has to be followed before publishing that accounts or financial statement to the public or stakeholders. This graph or this diagram explain to you that what are the steps they have to follow before publishing a financial reporting, or this is the steps following in the financial reporting. As per the slide, you can understand that first they have to draft financial statements, which is obviously everybody understand. They have to draft based on their accounts and their assessment and sort of several procedures. They have to follow several procedures. Based on that, they have to prepare the draft financial statement. And then once they prepare the draft financial statements, then they will submit the draft financial statement to the board audit committee. Because board audit committee is the committee in charge for the internal audit matters, and the internal audit, they are checking whether adequate internal control systems are followed when they prepare the financial statements. They are the people sort of in charge for the internal audit function of the entity or financial institutions. So once they prepare the draft financial statement, they will just submit the draft, maybe chief accountant or CFO or chief financial officer. He will submit the report to the, or the table the report to the board audit committee. Maybe through the internal auditor, or directly they will submit to the board audit committee. The board audit committee is the board subcommittee, which is responsible for internal audit function of the entity. So once they draft a financial statement, they will just submit it to the board audit committee, and then board audit committees review that accounts. So once they reviewed and approve, so with the recommendation, they will submit the report to the financial statements to the board of directors. So now it is coming to the third position. So first they drafted, the CFO financial division will draft the financial statement that will be submitted to the board audit committee, and board audit committee, what they will do is they will review all the things and they will get the internal auditor statement on these accounts and internal control procedures. If there is any material misstatements or anything, they will just check about those things. And once they reviewed thoroughly and they are satisfied with that, so with a recommendation, they will submit it to the board of directors. Actually, in the financial, in any entity, the company, the board of directors have the ultimate responsibilities and authorities. So that board, they will submit it to the board of directors, and the board of directors, once they satisfy with that, they will review that. Once they satisfy with the that accounts, they will just start the commence the audit. So the draft account is ready, the financial statement is ready. Then they will submit those to the commencement of audit. So external, now at this point, external auditor get involved to check the why the external auditor is get involved, because external auditor on behalf of the shareholders, he is the person, the external auditor is going to give the assurance or sort of assurance to the shareholders, the accounts are true and fair and there is no material misstatement. So for that purpose, it's the commencement of audit, then they will commence the audit, and that audit, once they finish the audit, they will give the management letter. So where they have identified any material issues and problems, though they will include those things in the management letter, and they will prepare the management letter, and if there is any adjustment necessary, they will recommend that, and then audited financial statement, once they submit the management letter and all the things for process finish, then that audited financial statement will be ready. So once the audited financial statement is ready, then the auditor will give sort of certification, the audit opinion on the financial statement. So once they give the audit opinion, then it will again go to the board of directors. So board of directors again review the paper, and if there is a review the account financial statement, and if there is any material issues in the accounts or anything, they will just rectify it, or they will take necessary arrangement. If everything is fine, then they will give and approve, they will sign it and approve for the publication purpose. Generally, the companies, the finance institutions publish annual reports. Even the companies, sometimes the annual report and financial statements are sort of different thing. Different thing in the sense, annual report will have more information than the financial statements. Because the annual report will give some qualitative information as well, but financial statement only the quantitative information. Mostly the quantitative information will be given by the financial statement, but annual report means it will give more comprehensive information about the financial status as well as business continuity and everything, all the information, if the risk management system, how they establish the risk management system, any subcommittees. There are several things. If you see an annual report, you can see a lot of information about it. It's a really an interesting point to read the annual report of good companies, good in the sense large companies. There are a lot of information, you can get it. So you can get it there. So they will just disclose the annual report and or publish in the press. If it is a banks and finance companies, of course they have to publish in the press. So these are the process they are following in the financial reporting. I have said here the process of producing statements. So what is the process? These are the process. The draft the financial statements and submit it to the board audit committee, and then through that the submit with the recommendation submit to the board of directors, commencement of the audit, and audit will commence. Then once the end of the audit, the management letter will be provided by the auditor. Then that audit will be completed and auditor opinion will be given to the on the accounts, and then with that audit opinion it will go to the board of directors, and board of directors satisfy and approve it, it will publish to the account. So these are the procedures following in the financial reporting. Understand? I hope you all understand these things. Okay, then we are going to move into the the legal and regulatory requirement on financial reporting of the financial institutions. The financial reporting is a common thing for any institutions. If it is a company, they have to prepare the financial statement. I think they have to give one copy to the registrar of company, and they have to audit it. But if it is the financial institutions, there are some legal and regulatory requirements on the financial reporting. They have to follow certain legal and regulatory and other requirements on the financial reporting of the financial institutions. Financial institutions can be the bank or finance companies, leasing companies, insurance companies, or stockbroker companies, etc. The first requirement is they have to follow Sri Lankan accounting standards, which is compulsory. Even if it is a financial institution or not, if it is a company's accounts, they have to follow the Sri Lankan accounting standard to prepare the financial statements. Or in the financial reporting process, it is compulsory to follow the Sri Lankan accounting standards. The second one is requirements of the Banking Act number 30 of 1988 as amended. Because there are several times the amendment has been done. Actually, the industry, as per the industry news, they are going to introduce a new Banking Act. There are some procedures going on. So, but now the presently the effective one is the number 30 of 1988, the Banking Act. So when they are preparing the financial statement or when they are doing on the financial reporting process, it is compulsory. If it is a bank, they have to follow the Banking Act number 30 of 1988. There are some requirements. If it is the finance companies, number 42 of 2011, the Finance Business Act requirement has to be followed. If it is an insurance agent, insurance company, then number 43 of 2000, Insurance Industry Act has to be followed. The requirements of the Insurance Industry Act has to be followed for the insurance companies. For listed companies, of course, the listing requirement of the Colombo Stock Exchange. As per the listing requirement, there are several requirements. They actually every quarter they have to submit their financial statement in a prescribed format. If you see the Colombo Stock Exchange website, you can see that. It is interesting just to review the other companies' the financial statement and see what is their status, financial statement. So there are some formats. As per those formats, these listed companies has to give the accounts on quarterly basis. For the annual basis, there are some statements. The quarterly statement, of course, has the only quantitative data. But if it is the annual report, it will have qualitative plus quantitative information. And the requirement of the Companies Act number 7 of 2007. And the relevant regulatory directions and guidelines. Of course, if it is a Bank Supervision Department of the Central Bank issue some regulatory requirements. And if it is a finance companies, again the Central Bank for non-bank financial institutions department will issue some or will not. They have some directions, so they have to follow those things. So if there is any questions in the exam paper, what are the legal and regulatory requirement on the financial reporting of the financial institution, then you have to write they have to follow the Sri Lankan financial standards, the requirement of the Banking Act if it is a bank, or the Finance Business Act if it is the finance companies, And insurance companies, of course, it's Insurance Industry Act. Same wise, if it is a listed company, the Columbus Stock Exchange listing requirement, as well as if it is the Company Act requirement, also regulatory requirements. So these are the things you have to list it out. Understand? Okay. Then these are, we have seen that they have to follow the Sri Lankan accounting standards. Okay. So what type of the standards? The first one is SLFRS 4, the insurance contract, which they have to follow. The second one is Sri Lankan SLFRS 7, the financial instrument disclosures. And SLFRS 9, of course, everybody knows that if it is a financial industry, you may know about the financial instrument and treatment, and SLFRS 13, fair value measurement, and LKS 1, presentation of financial statements, and property, plant, and equipment standard, as well as SLAR 24, related party disclosure. So these are some of the accounting standards they have to follow when they are preparing the financial statement in the financial institutions. Any doubt you all wanted to ask from me, you all can ask. Always welcome. Otherwise, I can move to the other section. Okay. Here we have seen that first. Actually, in the initial slide, we are saying the financial accounting standard, where we have said this some relevant accounting standards, so which will they have to follow. Then second, we say that the requirement of the Banking Act, Business Finance Act, and Insurance Regulatory Act. What are the requirements? Here, the requirements are given for the Banking Act. The first column, if you see the second column, it is about the Banking Act, BA, and Business Finance Act, the FBA, and IIA, Insurance Industry Act. So based on that, what are the requirements they have to follow? The main requirement. The first one is format. Audited financial statement as per the specified format by the regulator or comply with accounting standards. Actually, for the banks and finance companies, the regulator, the central bank, prescribes some format. Okay, you have to publish in the paper based on this format. Why they are prescribing format? Because the certain minimum information has to be given to the public or stakeholders. That is the purpose they prescribe. Okay, you have to follow these formats. So based on this format, you have to publish the accounts. So that is one thing. Another thing is comparability. Because if it is the same format only, they can compare it. The same kind of information only, they can compare, the stakeholders can compare, because the financial reporting, the comparability is one of the most important things. So they have to compare the things. Otherwise, no point. For example, the company A, which is a financial institution, which give accounts in a different format, and company B, which is also a financial institution, which is given total different formats, and there won't be any comparability. So that's why they just prescribe some formats or the accounting standard requirement they have to follow. And submission, of course, for the bank supervision, as for the bank, as per the Banking Act, if it is a bank, they have to submit the financial reporting, the annual accounts, within 5 months to the DBS. DBS means Director Bank Supervision. If it is the finance companies, they have to submit within 3 months to the Director Non-Bank Supervision. Non-bank supervision of non-bank financial institution. Director supervision of non-bank financial institutions. So they have to give annual accounts to the financial statement, annual financial statements to the director within 3 months period. If it is an internal audit in Insurance Industry Act, or if it is an insurance company, they have to give within 6 months to the insurance board. So these are the submission requirement as per the act which we have discussed in the previous slide. And if it is the banks, they have to publish within the 5 months, annual accounts they have to publish within the 5 months in 3 languages. Again, the similar thing, if it is the bank finance company, they have to publish within 3 months in 3 languages. But of course, insurance company, there is no such a requirement. Financial statements at each business, customer disclosures. Actually, even if it is a bank, for example, if I'm a customer, I'm going to a bank branch. If I ask annual report, not taken to my home, but to just check the annual report, they should provide at any branch. It should be available in the business places. Business places mean branches, particularly if it is a bank or finance company, it should be available in each and every branch. If a customer wanted to see their annual report, they had to show. Because as a depositor, I must ensure that whether safe and soundness of the, I must to check whether assess the strongness of the financial strongness of the particular bank. I have to check. I have to just review before depositing the money. So when I am asking as a customer, when I am asking that, it should be disclosed or displayed in the branch level, business places. And auditors, of course, panel of list of qualified auditors. Actually, if you see that the bank central bank website, there are a panel of auditors for the banks. For the finance companies also panel of auditors are available. So based on these things, actually based on the panel of the list of qualified auditors, they have to select, the banks has to select one of the auditor for the auditing purpose, external auditor. They can't give to everybody actually. There are, because the auditors also, there should be certain requirement, the certain condition has to be stipulated by, has been stipulated by the regulator, and those who are complying that requirement, they are listed under the list of qualified auditors. So the bank has to hire a qualified auditor from that list. One of the auditor, there is no anything, but one of the list, if it is 10 people, one of those 10 has to be selected for the audit. So these are the requirement under the Banking Act and Business Finance Act, as well as Insurance Industry Act, for the annual report, annual financial statement of this finance institution. Any questions you all wanted to ask from me? If you all have any questions, I can just let me know. If you all have any questions, let me know. I can answer. Otherwise, I'll just move into the other section. Here, in this section, we are going to move into the sort of new sub area. So far, we have seen about the definition of the financial statement, financial reporting. Then we have seen about the, we have discussed about the stakeholders and stakeholders, why the financial reporting of financial statements are necessary for stakeholders. Then we have seen the legal and regulatory requirements with related to the financial statements of the finance institution, and we have seen it in a very detailed manner. Now we are going to move other section, which is about the major disclosures in financial statements. So in the financial statement, what are the major disclosure has to be made? First one is why disclosures are important and required. Because, okay, the people, the regulators or government or anybody saying that, okay, there should be minimum requirement, disclosure requirements. So first thing is why disclosures are important and required. First one is to provide useful, accurate, consistent and comparable information for decision making of the users or stakeholders. Actually, when they provide, it should be useful information. That disclosure should be useful and accurate. That is most important thing. Why the disclosures is important? It should be provide accurate information. Sometimes some informations are not adequate enough to give an accurate information. So to give an accurate information, there should be some disclosures. For example, the contingency liability or something like, for example, in the finance statement, for there may be some notes to accounts. In the notes to accounts, if there are some material contingent liabilities are there to the institution, then it has to be disclosed to give an adequate adequate or accurate information. For example, as I mentioned, there may be a sort of legal case, litigation is going on. So the lawyers of the view that this case will not be favored to the company. So the company may have to incur the large amount of losses that may affect the finances instrument. So even though we are saying that this much of assets and liabilities are there with this much of earning there, but due to that there are sort of contingent liabilities there, or there should be sort of possible losses are there. So that has to be disclosed. So that will give an accurate information about the finance statement and consistency. Because if some institutions are giving some information and some are not giving, that may not be, for example, even within the institution mean the last year we are giving some information, but this year we are not giving some information, then there won't be a consistency, because consistency is important to compare the finance statement, even within the particular institution from the historical information, comparability. If you see this financial modeling, the financial modeling saying that there's a model called three-statement model. In the three-statement model, they are just comparing the historical data. For the comparing the historical data, there should be a consistency. So for that purpose, to provide useful, accurate, and consistent and comparable information for the decision making of the users, there should be a disclosure. Understand? Other one is why the disclosure is there to comply with the statutory requirement. As per the accounting standard, even the regulatory requirement, the related party requirement, the statutory requirement, one of the accounting standard, the related party transaction has to be disclosed. One of the statutory requirement. There may be some other statutory requirement. So to comply with the statutory requirement, they have to have the disclosures. Maybe the statutory requirement through the accounting standards mainly. And to maintain investors and depositors' confidence and thereby to promote the financial system stability. That's most important here. Why the disclosures, financial statements and disclosures are requirement because in the banking business, the finance business, totally depend on the confidence. If they lose the confidence, if the public lost the confidence, then they can't mobilize the deposits and investments. The confidence is most important. So to maintain the investors and depositors' confidence and to promote the finances, why they here? This is just for your knowledge. Why they connect the depositors' confidence and financial system stability? Can anybody elaborate me? Why these people? Why they say that to maintain the investors and depositors' confidence and thereby to promote the financial system stability? For example, if I lose the confidence on the particular institution, why it will affect the financial system stability? Because here, as I mentioned already to you all, or I have already discussed with you all in the previous topics, in the banking business or finance business, the customer confidence, the regulator, the public confidence is most important. Public confidence. If the people believe on the financial institutions only, they will come and deposit the money with that particular institution, because they are going to keep that money with a particular institution of a bank or finance companies with the confidence that, or with the by trusting that they can get back that money after certain period. It may be 1 year, 2 years, 5 years. They should have that confidence. Actually, if you go and buy something in the supermarket, there need not to be much confidence. Of course, there should be some confidence on reliability on that product. But okay, if I am buying a popular brand biscuit from that institution, okay, I am giving money, and if I get that popular brand biscuits or something, some item, popular branded item, I will just finish it off. I may not have much. I need not to have much confidence on that transaction. But if I want to go and deposit with the financial institution, I must have confidence on that financial institution, because I am going to give the money to them with the trusting that they will give back this money in a 1 year time or 2 years time or 5 years time. Okay, that is the confidence everybody know, but then why the one institution will affect? Actually, if that is the case in the financial institution, for example, if the customers or general public lost the confidence on the particular bank, and what will happen? Again, the deposit run or bank run will start. So if they lose the confidence, the depositors will go simultaneously and ask the money. Okay, so once they ask the money simultaneously, the bank run will start. Okay, if it is a one institution, what will happen? It may have the contagion effect to the financial system. What is contagion effect? If it is the deposit run starts with the one bank, it may spread it to other banks as well. Contagion effect. And through the contagion effect, it may affect the other institution as well. Then finally, that will affect the financial system stability. Understand? Because in the studying a topic is two objective. First one is getting the knowledge. Second one is pass the exam. Before having the second objective, we have to have a first objective, getting knowledge. That is what actually the central bank mandatory is to safeguard the financial system stability. That is the mandatory of the central bank. But to comply with the mandatory, the central bank interested on check the safe and soundness of each and every financial institution coming under their purview. Because if something goes wrong in one institution, that may have the contagion effect to the other institution, and system as a whole may collapse. So that's what here it says, that to maintain investors and depositors' confidence and thereby to promote the financial system stability, the disclosures are important. The financial statement disclosures are important. Understand? The fourth one is to help identifying various type of risk and effectiveness of risk management framework. The disclosures are important. Actually, the financial institution compared to other institutions, if it is a manufacturing company or service company, compared to those institutions, or retail business companies compared to those business, the financial institutions having comparably more risk in their day-to-day businesses. And especially they are having some financial risk in addition, because other institutions may have, other companies may, entities and companies may have operational risk. But these companies will have financial risk in addition to the operational risk. So then identifying the type of risk and effectiveness of risk management framework and all is much more important in the financial institution. That's why the disclosure requirement is important. For if you see that some banks, the bigger banks, large banks annual report, the risk management disclosures are nicely given, nicely written up the annual report. If you see that there are 3 lines of defense and integrated system, how they are managing credit risk, and all the disclosures are given. Encourage arm's length transaction, no favorable treatment, and to prevent unethical practices. For that purpose, which disclosure requirement is important? Okay, we are saying that disclosures is important to encourage the arm's length transaction, no favorable treatment, and prevent the unethical practices. The disclosures. So, for this purpose, which type of disclosure requirements are required by the regulators or accounting bodies? Which type? The related party transactions. If you see the related party, why they ask the related party transaction? Because it has to be disclosed, because to encourage the arm's length. For example, if it is a related party transaction, they disclose that, okay, this company, it is the 100 million rupees or 500 million rupees has been granted to related party at 1% interest rate. Then the stakeholders will get to know that this is will not be an arm's length transaction. And there's a favorable treatment and all. So once if the accounting or financial reporting having the disclosure requirement, and then if there is a real disclosure, then what will happen is that there will not be such a unethical practices in the industry. So encourage the arm's length transaction, no favorable treatment, and to prevent the unethical practices, the disclosure requirement is most important. And to promote transparency of information on the affairs of the business and to promote the market discipline, the disclosure requirement is important. So these are the some of the way why we need the disclosure requirements, or disclosures are important or required. Understand? When a company or financial institutions giving more and more information or disclose more and more information, to such an extent, there will be a transparency. There will be a more market discipline. If that's the purpose, the disclosures are important or required. Understand? Anything you all wanted to ask from the disclosure requirements or importance? If anything if you all wanted to ask, you can ask from me, or you can say it right. Okay. Then the next one is methods and ways of disclosing financial instruments. So, okay, we say that, okay, there should be a disclosure, disclosure requirements are important. And then they are asking that the methods, what is the methods and way of disclosing financial information? What are the methods? The first one is quarterly publication of finance statements. If it is a bank or finance companies, they are playing with the depositors' money. But for that purpose, the regulator, the central bank require to publish quarterly publication on the finance statement. Even if it is a listed companies, they have to publish a quarterly basis. They have to send the information to the they have to send the information to the SC, Columbus Stock Exchange, CSC, and they will publish in their website. So that is one of the important thing is quarterly publication of the financial statements. Then that is one of the method. And second way is publication of annual reports. Annual reports, of course, giving more and more information. So that is one of the method to have a disclosure, or the one of the method or way of disclosing the financial, the annual report. Annual report giving the risk management and their structure, the governance structure, the corporate governance requirements. All the informations are given in the annual reports. And press releases, of course, time to time. If you see the banks, even the central bank, not central bank, the banks and all, they are giving, they are making the press releases. Especially when they are earning huge profits, they just put all the disclosure, all the press releases and all. Okay, we have earned the 5 billion, 10 billion profit. This is the highest profit in the industry. Profit in the industry. Likewise, they will make the press releases. This is one of the way of disclosing financing. And financial information posted on website. Actually, it is, of course, it is one of the way to disclose the finance information. And regular reporting to regulators, CBSL, Insurance Board, and SEC. So they are regularly they have to report those things to the regulators. That is one of the way to disclose. And the second one, the other one is financial report to the government agencies, example tax authorities. Tax authorities, of course, we can just see that they have to submit the accounts, and tax accounts separately they have to publish. They have to publish in the sense they have to separately submit that accounts. And prospects pertaining to the issuance of common stock and other securities. That is one of the other way to disclose the finances or financial informations when they are, especially if you follow that the financial markets, when they issue when a company or financial institution issue a debenture, what they are doing is they are they just publish a prospectus, or if they go for an initial public offering, IPOs, they publish a prospectus. In the prospectus, they are publishing all the information. They disclose all the information. So these are some of the ways and method to disclose the finance information. The quarterly publication of financial statement, publication of annual report, press releases, financial information posted on website, regular reporting to regulators, financial report to the government agencies, prospectus pertaining to the issuance of common stock and other securities. So these are the methods following by the banks and financial institutions to disclose. Any doubt you will want to ask? Anything? If you all don't have the questions, then I can just move to the next slide. These are applicable laws and regulations on disclosures. Of course, Sri Lankan accounting standards. These are some of the standard which applicable to the laws and disclosure. Contents of financial statements, SLAs 1 and SLFRS 7, finance instrument and risk management, and SLFRS 13, fair value disclosure, and LKS Sri Lankan accounting standard 24, related party, which are sort of some of the accounting standard which related to the disclosures. And corporate governance, of course, which I actually, the next topic after this financial statement analysis and audit, we will discuss about the corporate governance disclosures. And corporate governance disclosures, there are two institutions publish the corporate governance standards or code of conduct to the to applicable to the Sri Lankan companies. One is Central Bank of Sri Lanka, of course, published the corporate governance for the banks and finance companies. The second one is Securities and Exchange Commission and CS Sri Lanka, the Chartered Institute of Sri Lanka, which also publish a corporate governance. That is one of the, those two are required the corporate governance disclosures. I think this is, we have already discussed with you all, I have already mentioned, just to refresh your mind. Who are the regulators, or how many regulators are in Sri Lanka? For regulators for financial institutions, or what are the who are the regulators in Sri Lanka for financial institutions, or how many? There are 3 or 4 regulators there. The first one is Central Bank of Sri Lanka, which is the main regulator. The second one, which regulate the banks, finance companies, microfinance companies, as well as leasing companies. Microfinance companies, of course, very recently they issued the license. And primary dealers. So they are the sort of regulator, pioneer regulators. And the Securities and Exchange Commission, which regulate the stockbrokers and listed the stockbrokers and all, unit trust companies, those capital market related people. And insurance company, insurance regulatory body, which regulate the insurance company. And the fourth one is cooperative commissioner, which regulate the rural banks. So there are mainly 4 regulators in Sri Lanka. So the corporate governance disclosure, the 2 regulators publish the corporate governance code of conduct for corporate governance. First one is Central Bank, second one is SEC along with the Chartered Institute. So that corporate governance disclosures are required by they have to satisfy these 2 institutions. If it is a bank, they have to fulfill this CBSL as well as the second one. And if some institution, of course, second one is enough. And then under the Basel III Pillar 3 market discipline, there are capital and risk management disclosures are required by these Basel III requirements. Basel III, of course, I think I need not to explain to you all, because you all may have as a people who are highly who may work in the financial institution, so may have more knowledge on the financial institution. I need not to explain to you all about the Basel III. Is it so? Yeah, I have an assumption that you all are having, or otherwise I think that later on we can discuss. I can give sort of introduction on the Basel III later on. And the continuing the listing requirement, that is also one of the disclosure regulations on disclosures, and Global Reporting Initiative (GRI) is one of the things. So these are the applicable laws and regulations on the disclosure. Sri Lanka Accounting Standard, Corporate Governance Disclosure, Basel III, Pillar 3, Market Discipline, SEC, Listing Requirements, and Global Reporting Initiatives. So these are the things you will have to mention. And the disclosures in the financial statement, primary financial statement, there are 5. I have said that 3 is most important, but there are 5 financial statements are there. First one is income statement, the balance sheet, income statement, changes in equities. Of course, that will be in the balance sheet, but changes of equities and cash flow statement and notes to the financial statement. There are 5 financial statements. 3 is most important, but generally it's the financial statement. You have to primary financial statement. You have to mention the 5. What are those? Statement of financial position, which is the balance sheet. Balance sheet giving the asset and liability position of the bank or of the any entity a particular day, asset this date. Statement of the financial position. And second one is statement of comprehensive income. The comprehensive income, of course, there are 2 things currently under this current accounting standard. As per the current accounting standard, there are 2 things: profit and loss account for the period, other comprehensive income for a period, OIC, OCI, PNL and OCI. So in the other comprehensive income statement, there are 2 statements: profit and loss statement and other comprehensive income statement. Because if, for example, there are I don't want to get involved with these accounting standards, but I just explained that for example, if a certain capital gain on the security revaluation gains, they may adjust it through, they will post it through this other comprehensive income. That's just idea you may have. And profit and loss accounts, of course, the regular things will appear. And statement of changes in equity, you may see that even some institution may publish the cash flow as a first or a statement as a third. Yes, as a third, where they just say that initially what is the stated capital, and then retained earnings, any revaluation gains and all. What are the each and every column which represent the capital or equity component of the company. They will have the column and the initial balance and adjustment for during the year, and they will give the in the end of the year balance. The statement of changes in equity and the statement of cash flow, which is also one of the important thing. They will that will give an idea about the cash flow position of the or liquidity position of the particular institution, cash flow or liquidity, and accounting policies and notes to the financial statement, which is also so. If it is the financial statement, you can say 5. 3 is very important, but the primary financial statement 5, the financial the balance sheet, P&L, equity, changes in equity, cash flow, and notes to the accounts. Understand? Anything you all wanted to ask these things from me? Any questions? The other one is the risk management disclosure. The risk management in the finance institution, of course, banks and finance companies and other finance institutions. I have already explained to you all that risk management is most important thing. And the risk management related disclosures are expected by stakeholders to have the decision making or policy making purpose. The first one is on quantitative and qualitative manner on the face of the finance statement as knows. That's what I have already mentioned. If there is any litigation or contingency liabilities, they have to mention. Okay, there's a case going on, so they have to. There may be losses. The second one is summary of the quantitative data about the exposure at each type of risk they have to give under the risk management disclosures. Summary of the quantitative data they have to give. And management objective policies and procedures for managing those risks. That's what I say, that if you see the annual report nicely written, whether they are following it or not, very nicely written in the books, annual report. So where they have to mention the management objective, policies and procedures for managing those risks. If it is a credit risk, what are the objective and appetite and tolerance, as well as what is the objective and policies and procedure, everything has to be. And liquidity risk, everything, and market risk, and operational risk, IT risk, they have to mention. And disclose about the credit risk, liquidity risk, market risk, operational risk, and interest rate risk, and how these risks are managed has to be disclosed in the annual reports. So that's what I have already mentioned to you all. This financial risk is most important in the financial institution. Credit risk, liquidity, market, interest rate risk, those type of risk. And nowadays the operational risk coming as emerging as an important risk to the financial institution. Why? Because there's a high involvement in the IT. So there are significant number of risks are created through this IT. So the banks and finance institution, banks and finance company or the finance institution has to disclose these risks and how this management everything, and change in respect of risk management practice from the prior period. Okay, if there is any changes, significant changes from the previous period to this accounting year or this period, then they have to disclose, okay, this is the significant changes take place during the period, or we are expected to change this type of risk management policies. They have to disclose all these things. These are related to some disclosure related to the risk management. Understand? Okay, under the disclosures under the risk management, they can just say the risk management framework, structure, committee, exposures of the different risks, policies and procedures, techniques, models, and method for risk management on each type. But it is the structure, the risk management. I have mentioned to you all that the different risk management and the different institution may have different structure, risk management structure or framework. Some are silo based framework, some are integrated risk management framework. If it is silo based structure, I say that they will manage the risk. But if it is the integrated risk management framework, then under that structure maybe there may be a board audit subcommittee for risk management. Under that there will be a chief risk officer, and under a chief risk officer there will be a risk management department, centralized risk management department, and under that so in every department there may be risk officers, and through that they may collect the information, escalate the risk to the top management. The structure will be as to disclose to the stakeholders. What is the structure related to the risk management framework followed by the banks and finance companies and committees. The risk management related committees, of course, we can say, for example, the board risk subcommittee, risk monitoring committee, or compliance committee, credit risk management committee. There may be several risk management committees. So those type of committees also has to be mentioned, and their functions, and what are the objectives of the committees and all, and exposure for different risk. So what are the main risk exposed by the particular financial institutions, and policies and procedures and technique. This is, of course, I need not much related, but what are the risk management policies, and what are the procedure, what are the guidelines they are having, and techniques and models. All sort of information will be provided or will be given as a disclosure under the risk management in the financial statements, especially in the annual report. When they actually in the annual report only, they are giving the qualitative information, disclosure, most of the disclosure. Actually, disclosure means there may be the quantitative and qualitative information. These are coming under the qualitative information. The quantitative, of course, numbers. The profit how much and losses how much and all sort of things will be the quantitative. And under the credit risk, of course, they will give credit quality of the by type of financial assets. Type of financial assets mean what is it? There may be debt instrument, there may be equity instrument, there may be loans and advances, type of financial assets. So credit quality of the financial assets, for example, the loans and advances is one of the financial assets class. So how they express their credit quality? By NPL ratio. And for NPL ratio means non-performing loans and advances ratio. Through that ratio, they may disclose the credit quality of the type of finances. For example, the loans and for example, loans and advances credit quality will be disclosed by the NPL ratio, non-performing loan ratio. And age analysis of the assets and past due assets. Of course, there are in the non-performing loans. If those who are working in the banks and finance companies may have more understanding, the non-performing loans means the loans which have not repaid for 90 days or 3 months period. For example, if I borrow the loans and if I not repaid for 3 months period or 90 days period, then my loans will be classified as a non-performing loans. They are not performed, that they are not repaying, non-performing loan. And if it is a non-performing loans, of course, then after that, actually in the non-performing category also, if it is after 6 months, 3 months, they will classify it as a non-performing. After 6 months, it will be substandard, doubtful, and loss category. There are subcategories. All these categories will be disclosed. Age analysis, 3 months, 180 days, so on. And the risk exposure on internal and external risk rating concentration, sector-wise concentration. Sector-wise concentration we have already discussed in our risk management subject, where the loans and advances, for example, if a bank granted loans and advances, their total portfolio may be extended to different sectors. Maybe something for agriculture, something for consumption purpose, something for tourism purpose, something for retail business, trade and retail and wholesale trade purpose, likewise something for manufacturing companies. So likewise there may be sector wise. So sector wise concentration means, okay, out of their loans, which much of component will be given to the particular sector. For example, if it is a consumption loan, particular bank may give in out of their total loan portfolio, 20% of the loan portfolio may be given to the consumption purpose. Consumption purpose means credit card or pawning, and likewise there may be consumption purpose. So in the concentration and the risk management, they have to just check about the concentration, sector-wise concentration, 20% of the loan. Some banks may have very diversified loan for an advances portfolio, but some banks and finance companies may have highly concentrated credit portfolio. Highly concentrated means they are concentrating on 1 or 2, 3 sectors highly. So, for example, if a bank X, they may granted their 50% of the loans to the tourism sectors only. Then they say that 50% sector concentration is 50% out of the total. If it is 100 million, they are giving 50 million to the companies which are in the tourism. Why? What is the wrong with that? Because if something happen to that particular sector, the banks may have to bear more losses. For example, if it is the tourism sector, we can take the same example. Due to this corona situation, the COVID-19 situation, no tourists are coming. So most of the tourism companies are struggling. So at that time, the asset quality of this particular bank will get affected, because the companies in the borrowers in the tourism sector may not repay the loans in proper manner. So due to the high concentration in the tourism sector, they are affecting. It may happen to the agriculture sector even. If it is agriculture, there may be drought or flood. In that scenario, the harvesting purpose, the harvest may get affected. So if they are highly concentrated into one sector, there may be huge losses. So actually, the best strategy is diversify the sectors. And fair value of collateral is one of the other requirement under the disclosure requirement. And the second one, of course, the liquidity risk and funding management under this disclosures under risk management. They have to mention the main liquidity ratios. Liquidity ratios in the sense there are two main liquidity ratios they have to mention. The first one is statutory liquid asset ratio. Second one is liquidity coverage ratio. So there are different calculating method for these ratios. So they have to mention what is the ratios. Even these two, there are all currency and rupee and in both, so they have to mention. And then the finance asset and liability by remaining contractual maturity. This is sort of gap analysis. We are saying maturity gap analysis. The sense maturity gap analysis, I think we have discussed already. It means what are the inflows based on the maturity pattern of the assets. They have to categorize the assets in the maturity pattern, and the liabilities also they based on the maturity pattern they have to categorize, and they have to see the gap, maturity gap based on that. So that is one of the liquidity and funding risk management under that. Actually maturity, you can see in the annual report, they may give the maturity gap analysis, which is also one of the regulatory requirement. Central bank required the banks and finance companies to disclose the maturity pattern of the assets and liability. We have discussed about the ALCO, the asset and liability committee. Actually, the ALCO will decide, or ALCO will manage this maturity gap analysis as well. Understand? And contingent funding plan, which we have already discussed, and commitment and guarantees, which means there may be the guarantees and commitment given to the customer as off balance sheet item. So those may affect the bank's balance sheet, on balance sheet item. Those things has to be mentioned. So these are the some of the disclosures under the risk management. And then we have to discuss about the market risk or the disclosures under the market risk. Of course, interest rate risk, the rate sensitive assets and rate sensitive liabilities, which is like gap analysis, maturity gap analysis based on the interest rate sensitivity assets. There are interest rate sensitive assets and liabilities. Then there are the gap between that will be assessed, and impact of the P&L due to the interest rate shocks. And equity price risk and currency risk and stress testing. Of course, stress testing we have discussed already. Under the market risk, we can just say that even the solvency credit risk we can analyze if under the certain adverse scenario, what will happen to the company's balance sheet or financial statements, which is the market risk, and operational risk, of course, internal fraud and legal consequences. So these are the disclosure requirement under the risk management. And the related party disclosures, of course, this is which we have already discussed in the risk management as well, but here of course we can just see that the related party discloses the information on the related party and their relationship has to be disclosed in the financial statements. And then once they disclose the related party transaction only if there have been transaction, because they need not to disclose all the related party. If there is any transaction with the related party, they have to disclose. And nature of the related party relationship, information about the transactions. As I say already, if they granted loans, 100 million loans at this interest rate, they have to mention what is the nature of what is the outstanding balance of this information about the outstanding balance, information about the impairment, bad debts with the related parties. For example, if there is any the related party transaction, there may be 2-3 patterns. First one is they may give at a low interest rate or some preferential treatment. Second one is the related party may default it, maybe willful default. So may default it, and so if there is any default or bad debts, they have to disclose it. And these should be disclosed for each category of related party. Example, parent, subsidiary, associate, joint ventures, directors, key management personnel, major shareholders, other related parties. So everything has to be disclosures. I think under the corporate governance, we will discuss this in very detailed manner. But in the risk management, we have discussed a little bit. So I'm just slightly touch this slide, this topic, but we will discuss. We will have a very lengthy discussion under the corporate governance disclosure. Okay. Related party disclosures, of course, key management personnel disclosure, short-term employee benefit, post-employment benefit, and long-term other long-term benefits and termination benefits and share-based payments. All sort of things has to be disclosures related to the key management personnel. Because in any company, generally the key management personnel may expect high or may draw high benefits from the company. So which has to be disclosed in the financial statement. Then stakeholders will get to know that, okay, these key management personnel are getting this much of benefit, whether they are really worth to have in the company or sort of things later. So those. I think there are some other regulatory other disclosure requirements, and we have to see the ratio analysis and all. I feel by considering the time constraint, I'm going to stop this presentation at this level, or today's class at this level. In the next class, I will continue from this the slide number 18, the corporate governance, and then we will move into the audit. So far we have seen about the first we have discussed about what is financial reporting and why financial information is needed to the stakeholders. And then we have seen who are the internal stakeholders and external stakeholders and necessary. And then we have detailedly discussed on the financial reporting process. What is the process followed to the financial reporting purpose, and the legal and regulatory requirements. Of course, we have seen the accounting standard. We have seen what are the accounting standards we are it's necessary to for this purpose, and what are the requirements under the Banking Act, Business Finance Act, Insurance Industry Act, and all. We have discussed about it. And then major disclosure in the financial statement, we have seen about the why disclosures are requirements and method of the disclose, way of methods, and applicable laws and regulations under the under different requirement for the disclosures. And then primary disclosures in the financial statements and risk management disclosures. We have discussed in very lengthy manner in the risk management disclosures. And then related party disclosure, of course, we have discussed about the what type of the related party transaction has to be disclosed and all. But we will have this related party things in very detailed manner in the corporate governance section, which will be the next topic we will discuss. So we will have a very comprehensive discussion on the related party transaction, so that here, of course, you will have to have an idea that the company or entity or finance institution must have the disclosure related to related party transaction, the nature of the relationship and transaction. Then we have seen about the disclosures requirement on the key management personnel and their requirements. And actually, we are stopping with the corporate governance disclosure requirement, which we will see this in the next class, and then we will continue the audit section as well if time permits. So having that note, if you have any questions, you can ask, or otherwise what I can do is I can finish the class today, and we can start, or we can meet on next class. Do you have any questions? Okay, then since you all don't have the questions, we can wind up the today's class, and we will meet on tomorrow. Oh, sorry, next class. Bye.